You wake up in the morning and, almost out of habit, you reach for your phone. There is a message from your bank. A payment has been processed. $847 has been withdrawn automatically. You barely remember agreeing to it, but at some point, perhaps 3 years ago, you signed something. You said yes. The money is gone before you even feel as though you ever had it. And then it happens again, in 2 weeks, next month, and it will continue like this for the next 17 years. You tell yourself it is normal. Everyone has loans, everyone makes payments. Yet there is a quiet anxiety that lingers in your chest, something you cannot quite explain. You are earning a decent income, more than you once imagined, and still, somehow, you feel poorer than when you began. In the next few minutes, I am going to show you why that feeling is not only real, but entirely justified. Why loans are not merely financial tools, but psychological chains. This is what I call silent debt. Let me introduce you to Marcus. He is 29 years old and earns $72,000 a year. He has a university degree, drives a reliable car, and lives in a comfortable apartment. On paper, everything appears to be in order. But Marcus has not had $1,000 sitting in his current account at any point in the past 4 years. Not because he is careless, not because he lacks discipline, but because he is trapped. Marcus has 5 separate debts. His student loan costs him $340 each month. His car payment is $425. Minimum payments on his credit cards amount to $180. A personal loan taken during a medical emergency costs him $215. And a furniture financing plan, when he scarcely remembers signing, adds another $67. That is $1,227 every single month, before he has paid for rent, food, or anything else. Here is the unsettling part. Marcus did not wake up one morning and decide to be in debt. Each loan felt reasonable at the time. The student loan was an investment in his future. The car was necessary for work. The credit card balances built up gradually, an evening out, an unexpected expense, a flight home for a funeral. The personal loan was taken during a health crisis. The furniture, he simply needed a place to sit. Every decision made sense in the moment. But this is where the trap begins. Each loan came with a promise. That repayment would be manageable, that the monthly cost was affordable, that everything would work out. And technically it does. Marcus can afford $1,227 each month. It does not ruin him. But what no one tells you is this: something can be affordable without being sustainable. The system is not designed for you to pay off your debts quickly. Consider this. If you repay a $20,000 car loan within a year, the bank earns only a small amount in interest. But stretch that same loan over 6 years, and the interest increases dramatically. It is the same car, the same original amount, yet you pay far more simply because of time. This is the first mechanism of silent debt, time distortion. Your obligation is stretched across years, sometimes decades, until the true cost becomes almost invisible. A large debt no longer feels large because it is broken down into small, seemingly manageable monthly payments. A student loan of $50,000 spread over 20 years does not feel like $71,000. It feels like $296 per month. Your mind focuses on the monthly figure, not the total cost. But that additional $21,000 is the price you pay for time. It is the cost of not having the money up front. And there is something even more important. That $21,000 you pay in interest is money you cannot invest. If it had been invested instead, it could have grown significantly over those same 20 years. So the real cost is not only what you pay, it is what you lose the chance to build. Economists call this opportunity cost. In simpler terms, it is lost potential. Now consider what debt does to your thinking. When you have loan payments, your relationship with money changes. You no longer think about what you want to do with your income. Instead, you think about what you must do. Your salary no longer feels like your own. It has already been claimed by lenders, by banks, by past decisions. You become a channel through which money flows, rather than someone who controls it. You work in the present, yet your income is tied to the past, paying for things you have already used. The car you are still paying for may already be several years old. Its value is declining, yet the payment remains the same. The degree you completed years ago continues to demand payment long after its immediate benefit has passed. In a sense, you are paying rent on your own past. What makes this truly restrictive is not merely the financial burden, but the limitation it places on your choices. I once knew someone named Rachel. She disliked her job deeply. The environment was difficult, the work draining, and each Sunday evening brought a sense of dread. She had an opportunity to leave to pursue something more meaningful, but it came with a lower salary. She could not accept it. Her financial obligations required her current income. Her loans did not adjust for her happiness, her ambitions, or her well-being. They required payment, regardless of circumstance. So she stayed. What began as a temporary compromise became a long-term constraint. This is a form of financial imprisonment. The door may be open, but stepping through it feels impossible. The system relies on this. Lenders understand behavior remarkably well. When you enter into a long-term payment structure, you are committing a portion of your future income. Because payments are automatic, because they are spread out, and because they are so common, they feel normal. But normal does not mean inevitable. Minimum payments, for instance, are carefully designed. They are low enough to feel manageable, yet structured in a way that keeps you in debt for as long as possible. You may pay $50 towards a balance, but most of that payment goes towards interest. Your progress is slow, almost imperceptible. It feels as though you are moving forward, but in reality, you are standing still. Over time, this becomes a cycle. Because your income is tied up in payments, you struggle to build savings. Without savings, any unexpected expense becomes another loan, and each new loan adds another obligation. The cycle feeds itself. Debt prevents savings. Lack of savings creates emergencies. Emergencies create more debt. And so it continues. I would like you to pause for a moment and consider your own situation. Add up all your monthly payments, loans, credit cards, financing plans. Multiply that figure by 12. That is the portion of your annual income that is already committed before you make a single personal choice. Now imagine what your life would look like without those obligations. What could you build? What risks could you take? How much freedom would you feel? It is important to understand that debt is not purely financial. It carries a psychological weight. It creates stress, limits your options, and fosters a constant sense of pressure. Even when everything appears stable, there is an underlying tension, a sense that you are not fully in control. But there is another truth, one that is often overlooked. Debt as a permanent condition is not inevitable. Many people choose to live differently, not necessarily by earning more, but by prioritizing freedom over excess and flexibility over appearance. And once that decision is made, everything begins to change. So what can you do? First, avoid taking on new debt wherever possible. Second, begin reducing existing debt, starting with the smallest balances. Third, build even a modest emergency fund. And most importantly, shift the way you see yourself, from someone managing debt to someone actively eliminating it. Silent debt is subtle. It is designed to blend into everyday life, to feel ordinary, even unavoidable. But once you recognize it for what it is, you gain the ability to change your direction. You are not defined by your obligations. You are someone who made decisions within a system, and you can make different ones moving forward. If this message resonates with you, share it with someone who may need to hear it. And if you are ready to take control of your financial future, then this is only the beginning.